Are you ready to find out which of these two powerhouse tech stocks could deliver massive returns in the future? We're talking about Microsoft versus Meta Platforms, two of the most talked about stocks in the tech world right now. But here's the twist. Billionaire hedge funds are selling one and buying the other. So, which stock should you invest in? Let's dive in.
Hi.
In today's video, we're going to explore a battle between two tech giants, Microsoft, NASDAQ, MSFT, and Meta Platforms, NASDAQ, Meta. We'll break down the reasons why billionaire investors are making big moves, and we'll analyze the future potential of these two companies. Thank you for watching, and please subscribe to my channel, TheFinanceSavvy, for more updates and insights. If you have any questions, feel free to reach out. Let's dive into the video. So, what do billionaires know that we don't? Well, two high-profile hedge fund managers recently made moves in the stock market that got the attention of many investors. Here's the twist. Stephen Mandel of Lone Pine Capital sold Microsoft and poured his money into Meta Platforms. And the same story unfolded with Louis Bacon of More Capital Management, who drastically cut his stake in Microsoft and bought up a huge amount of Meta stock. Now, that might sound like a big deal, but we need to take a closer look at these companies to understand the full picture. Let's break it down. 1. Microsoft, a powerhouse with AI ambitions. Microsoft has always been a leader in the tech space. They've built their empire with software like Windows and Office, and their cloud services are a massive player with Azure. But in recent years, their AI investments have stolen the show. Strong Q1 2025 earnings. In the first quarter of fiscal year 2025, Microsoft posted a 16% revenue increase, reaching $65 billion, driven by enterprise software and cloud services, fueled by AI demand. And that's not all. They reported a 10% rise in net income, pushing their earnings to $3.30 per share. However, despite the positive numbers, the stock didn't see the same boost.
Why?
AI investment concerns. Microsoft made a $13 billion investment in OpenAI, the company behind ChatGPT. But this has raised some eyebrows. CFO Amy Hood revealed that the investment would cause a $1.5 billion hit to profits for the next quarter, which certainly dampened investor enthusiasm. They're spending a lot on AI, and the question is whether that will pay off in the short term. Valuation worries. Here's the rub. Microsoft is trading at multiple times earnings, a premium compared to its 5-year average. Its price-to-earnings growth ratio, PEG, is 2.7, which is considered expensive by most analysts. In short, Microsoft may have big potential in the AI space, but its stock could be a bit overvalued right now. If you're looking to buy, you might want to wait for a better entry point. 2. Meta Platforms, a rising star in AI and social media. On the other hand, Meta Platforms has been making waves. You might remember Meta as the company behind Facebook, Instagram, and WhatsApp. But here's what many investors didn't see coming. Meta is becoming a leader in generative AI. Strong Q3 2024 earnings. Meta delivered impressive results in its third quarter earnings, with 19% revenue growth, pushing their revenue to $40 billion. What's even more impressive is the 37% increase in net income, bringing in $6.03 per share. But here's the kicker. Despite beating estimates, the stock dropped following the earnings report.
Why?
Because while active users grew, they didn't grow as quickly as analysts expected. AI integration for better engagement. Despite the mixed reactions, Meta is making huge strides in AI. The company is using AI-driven features to enhance user engagement. Mark Zuckerberg recently shared that AI-driven recommendations helped increase time spent on Facebook by 8% and Instagram by 6%. Plus, over 1 million brands have used Meta's generative AI tools to create content. Meta's transformation into an AI-driven company could give it a major edge in the ad tech space, where it already ranks second, only behind Google's parent company, Alphabet. Valuation versus growth. Meta is trading at about 24 times earnings, which is slightly above its 5-year average of 25.5 times. Analysts are expecting 18% annual earnings growth over the next 3 years, which gives the stock a PEG ratio of 1.6, meaning it's much cheaper compared to Microsoft. So, Meta Platforms seems to offer more bang for your buck in terms of growth potential, especially with its AI investments starting to take off. So, which stock should you buy? Let's break it down quickly. Microsoft. It's a tech giant with strong financials and a foothold in AI. But its valuation is pretty high right now, and concerns over its AI investments and profit margins could pose risks. If you're looking for long-term stability with some exposure to AI, it's a solid pick, but wait for a better entry point. Meta Platforms. It's becoming a dominant player in AI-driven social media and advertising. With strong earnings growth, AI advancements, and a relatively cheaper valuation, Meta seems like the better pick if you're looking for growth at a good price. Patience is key here, but if the stock drops by around 15%, that could be a great buying opportunity. The big question: should you invest $1,000 in Microsoft or Meta right now? It depends on your strategy. If you're looking for long-term growth with AI exposure, Meta may be the stock to go for. But if you're playing it safer and waiting for the right entry point, Microsoft is a solid bet down the road. Analyzing Microsoft, NASDAQ, MSFT, and Meta Platforms, NASDAQ. Meta involves examining their financial performance, growth drivers, risks, and valuation. Here's a detailed analysis of both companies. 1. Microsoft MSFT. Overview. Microsoft is one of the largest technology companies in the world, with diversified revenue streams across software, cloud services, gaming, and artificial intelligence, AI. Its flagship products like Windows, Office 365, Azure, and LinkedIn have driven consistent growth. Recent performance. Q1 FY 2025 results ended September 2024. Revenue, $65 billion, up 16% year-over-year, YOY. GAAP net income, $22.3 billion, up 10% YOY. Earnings per share, EPS $3.30, exceeding expectations. The growth was driven by strong demand for enterprise software like Microsoft 365. Growth in Azure, its cloud platform, supported by rising demand for AI-powered services. AI investments. Microsoft's partnership with OpenAI, creator of ChatGPT, has made it a leader in generative AI. AI-related services are expected to hit a $10 billion annual revenue run rate in the next quarter. Analysts believe this segment could grow 10x to $100 billion annually in the future. Challenges. 1. Profit drag from OpenAI. CFO Amy had stated that OpenAI would contribute a $1.5 billion quarterly loss until profitability improves. 2. Free cash flow decline. Capital expenditures for AI infrastructure led to a 7% YOY drop in free cash flow, raising concerns about aggressive spending. 3. Valuation concerns. Microsoft trades at a forward P/E ratio of 30, above its 5-year average of 27. This premium valuation makes the stock expensive relative to its expected earnings growth of 13% annually over the next 3 years. Key metrics. Price-to-earnings growth, PEG, ratio, 2.7. Values above 2 are generally considered expensive. Strengths. Cloud leadership, AI innovation, strong cash flow. Risks. High valuation, slowing Azure market share, heavy AI investment. 2. Meta Platforms, Meta. Overview. Meta Platforms is the parent company of Facebook, Instagram, WhatsApp, and Oculus. It generates the majority of its revenue through digital advertising while expanding its focus on AI and the metaverse. Recent performance. Q3 FY 2024 results ended September 2024. Revenue, $40 billion, up 19% YOY. GAAP net income, $11.6 billion, up 37% YOY. EPS, $6.03, beating analyst expectations. Key drivers of growth. Increased ad revenue from Facebook and Instagram. AI-driven features have increased user engagement, with 8% more time spent on Facebook and 6% on Instagram this year. AI integration. Meta has integrated AI recommendations into its social media platforms, improving engagement and ad targeting. Generative AI tools. Over 1 million advertisers have used Meta's AI tools to create ads, further boosting monetization potential. Challenges. 1. User growth concerns. Active user growth for Facebook and Instagram has slowed, which may indicate saturation in key markets. 2. Metaverse spending. Heavy investment in its Reality Labs division, responsible for the metaverse, has led to significant operating losses. For example, Reality Labs reported $3.7 billion in losses in Q3, which could persist in the near term. Valuation. Meta trades at a forward P/E ratio of 24, slightly above its 5-year average of 25.5. However, with projected earnings growth of 18% annually over the next 3 years, its PEG ratio is a more reasonable 1.6, indicating better value compared to Microsoft.
Key metrics.
Strengths. Dominance in digital advertising, AI-driven engagement, high profit margins. Risks. Metaverse uncertainty, slower user growth, potential regulatory scrutiny. Side-by-side comparison. Microsoft. Revenue growth. YoY, 16%. Meta Platforms, 19%. Net income growth. YoY Microsoft, 10%. Meta Platforms, 37%. Forward P/E ratio. Microsoft, 30. Meta Platforms, 24. PEG ratio. Microsoft, 2.7. Meta Platforms, 1.6. AI revenue run rate. Microsoft, $10 billion, expected Q4. Meta Platforms, $40 billion, ad-driven AI. Key risks. Microsoft, high valuation, profit drag. Meta Platforms, metaverse losses, saturation. Investment insights. Why choose Microsoft? 1. Stability. Microsoft offers a diversified revenue base with long-term growth from enterprise software, cloud services, and AI. 2. AI leadership. Its partnership with OpenAI positions it as a leader in the AI space. 3. Dividend. Microsoft pays a dividend, yield 0.8%, which may appeal to income-oriented investors. Best strategy. Wait for a pullback to reduce valuation risk before buying. Why choose Meta Platforms? 1. Value play. Meta's lower PEG ratio and higher earnings growth make it an attractive option for growth investors. 2. AI monetization. Meta is successfully leveraging AI to enhance engagement and boost ad revenue. 3. High profit margins. Despite investments in the metaverse, its core ad business remains a cash cow. Best strategy. Consider initiating a small position now and buying more on pullbacks if the stock drops 10 to 15%. Final thoughts. Both Microsoft and Meta Platforms are leaders in the tech space, with exciting growth potential from AI. However, their strategies and risk profiles differ significantly. If you prioritize stability and diversification, Microsoft is the better choice, but patience is required for a better valuation. If you're willing to take on higher risk for potentially higher returns, Meta offers better growth prospects and a cheaper valuation today. Ultimately, the choice depends on your investment goals and risk tolerance. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to The Finance Savvy for more insights. Got questions? Feel free to reach out. We'd be happy to help. Stay smart, stay savvy, and happy investing.